Hi, Chris Duff, vacant land funding partner over at Serious Land Capital. So today I wanted to discuss subdivides and properly assessing child parcels. This is a routine issue that we see again and again, and I've definitely commented on before, but because it's so common, it just bears worth reminding and reiterating upon constantly, just given how much capital can be at stake going after subdivides and potentially getting caught into very risky deals by not assessing these type of opportunities properly here. So we were just reviewing a much larger deal north of $1 million purchase price earlier today and had the option for maybe doing between 10 to 25-ish child parcels for the property, kind of depending on how you might split it up. But roughly that's what it was going to look like. The issue is when we're trying to divide out the various uh, child parcel mapping process when we're looking at a potential subdivide, you're very rarely going to have just um, a similar featured parent parcel where the terrain is exactly the same, road access is precisely the same, foliage, etc., is all identical. Yeah, there are some areas, especially if you're out further, desert land, for instance, but that engenders its own complexities to that market anyway. But if you're assessing anywhere else, usually there's going to be more unique characteristics associated with each potential child parcel that you're looking to divide off from the parent. And most of the time, there's going to be some that are going to be potentially higher value for an end buyer and more attractive versus others. So, for instance, the one that we were looking at today, there were some very attractive possible child parcels, some with smaller ponds on it. It's unclear whether they were stocked or anything. Much more clear pasture land. There might have even been some existing fencing on the parcel. It was a little unclear from the aerial. So those I would be willing to attribute a higher price per acre for the actual exit. But when you're stuck purchasing an entire parent parcel, you always have to be considering the weak link exit potential for the worst quality child parcels. And in this case, there was, upwards of half of the parent parcel property that were going to be affected by active oil wells, pipeline crossing much of the property, significant power line easement, a little bit more rolling terrain, as well as deeper foliage. Plus, there was existing energy infrastructure. It was a little unclear what type precisely. And this wasn't, an area of the country where energy infrastructure is very common for residential usage, like in West Texas, near Odessa, Midland, what have you, where people are used to it. So this was an area where it wasn't as routine to have residential or even recreational properties that had all that infrastructure. So when you see things like that, then you're going to have to understand, okay, are there, what are the access rights for the property? Is there some existing mineral lease? Assuming mineral rights don't convey, you want to figure that out as well. Are there any building restrictions or insurance requirements to build over a pipeline easement? We've run into that issue before. I'll have to do another episode going into that in more depth. But those are all issues that you need to sort out prior to really engaging in deeper diligence for a possible subdivide. So whenever I see that, I'm like, okay, that's a possible issue. that we're going to have to examine and see if it's backed up by any existing sold or even active comps on the market. Are those typical features that can be overcome by an end buyer pool with enough underlying demand within that particular market? So that's always something that I'm going to be having in mind even before I start to assess the existing comps on market. So it's always, reviewing the underlying parcel first and all of its characteristics, and then moving into comps, which you'll see me return to again and again and again because it's so often forgotten by a lot of people within the land industry. And plenty of times I've made that mistake and paid dearly for it. So, it serves as a reminder for myself too. But when it comes time to actually review those comps, yes, you want to be assessing, okay, are those characteristics incorporated within those comps? And if not, then how much do I need to discount the exit price per acre to account for those negative features? And what's even more concerning is that, all right, if I'm looking to do a full subdivide here, are there any existing subdivision projects within the area that were successfully completed within the last year or two? And if so, how do their child parcels compare to the possible ones we might add onto the market? And how long did it take for all of them to sell with price per acres associated with them, whether that's in a disclosure state or properly discounting the price per acre in a non-disclosure state? So, the situation that we saw today was there were a couple of other possible subdivides, well, not possible, but there were minor subdivisions done in the area that were overall more superior in terms of features than the possible subdivide that we were looking at. And it took close to a year or more to dispo all of those child parcels. So if I see that, then I'm already going to be more conservative because I have an inferior parent parcel to move from. But even if I had an equally kind of attributed parent parcel in terms of characteristics as the that I'm looking at, I'm going to want to be undercutting the exit price per acre anyway to try to move a bit faster. I want to get in and out, even for these larger subdivides, with a target of a cap of 6 months, with the understanding that it might be double than that just for unforeseen issues or the underlying adverse selection that may come up with my buyer pool. But I want to be preventing that as much as possible by more conservatively pricing my potential parcels on the market. So with all of that in mind, that's what I'm initially looking for and seeing, okay, are there existing child parcels on the market? Did they sell? How long did it take to sell? What was the price per acre that they actually sold for? And in association with that, are there any remaining active parcels that are from other existing minor subdivisions or just similarly featured one-off parcels that are sitting on the market for any given time? What are their price per acres? How much do I need to undercut in order to beat out what's still on the market as well as what's sold in the past recently? And usually when I'm looking at all of those various features, most minor subdivisions from a parent parcel perspective do not pass the sniff test, because many, I could say probably 90% of land operators overestimate, or rather underestimate, how long it's going to take to sell all the various child parcels, and overestimate the amount that they can get from them in terms of an exit PPA or price per acre. So that's just a recurring lesson over and over and over again. I see this. You'll probably hear me comment on this again in the future because of how common it is, but it bears reiterate constantly. Hope you all enjoyed this episode. Again, if you're ever looking for land funding, check out seriousland.capital. We are the largest equity funding partner on the market. Preferred 50 to 100K purchase price deals. Check out landpricer.ai for software solution that prices land across the US. And if you want zero cost due diligence, I host Land Daily Diligence Thursdays. With that, take care. See you the next day.